Good day, grade 12s. Welcome to Business Cycles Exam Prep. My name is Carden Madzokere. I'm the author of the Distinction Bound Student textbooks. I have grade 10, 11, and 12 textbooks. Okay, so in this lesson, as usual, this is, I think, the fourth exam prep lesson that I'm doing. So I'm mainly focusing on section B. If I in future I'm going to do maybe section A and C, but for now I'm mainly focusing on data response questions. Right, so let's get started. This one will be study the cartoon below and answer the questions that follow. So let's see what we see here. South Africa exits a recession. So we're coming out of a recession with 2.5% GDP growth. All right, so we should know what a recession is. Anyway, it's the first phase of a downswing. We have two phases there. We have a recession and a depression, and a country is said to be officially in a recession if it goes for 3 consecutive quarters of negative economic growth. So here it's saying South Africa exits recession. All right, then what else we see is we bottomed out. Let's get out. Okay, we are at the bottom, so the bottom will be a trough. Agriculture and mining, yahoo. Okay, whatever. Growth in the agricultural sector is going through the roof by 33.6%. All right, so things are going well at this time. Not like currently, because currently we're actually going through a recession. I'll talk about it later. Mining grew 3.9%, contributing 0.3 of a percentage point to overall growth. Then secondary sector grew 1.9, and so on. Name one characteristic of a trough of a business cycle. So what's happening during that period? So all these things are happening: lower business activity, decreased in consumption. This is just before the economy starts to recover. High unemployment, decrease in profits, and so on and so on. So if what we are going through right now is a recession, we'll go through a depression, and then after that we'll start to recover. During that bottom part, this is what will be going on. Right, in which sector does agriculture operate? That will be the primary sector, because we have primary, secondary, and tertiary. Briefly describe the term business cycle. Business cycles are successive periods of fluctuations in economic activity, and some like to say expansions and contractions and so on. What economic spin-offs will you see this 2.5% they're talking about here? The question is, what economic spin-offs can result due to this? All right, look, if the economy is going up at a rate of 2.5%, obviously a lot of good things will be happening. All right, more employment in the economy, more investments in capital intensive methods of production, more participation in the economy, because look, things are getting better. Increased consumption and productivity. They could create high inflation, yes, and the type of inflation that will be created here is the demand pull inflation. And then inflation could increase due to higher supply, and then increase in interest rates. Yes, the repo rates will be increased as a measure of trying to curb this problem. How can the mining sector stimulate economic growth? Okay, the mining sector itself, it could improve the production techniques, like the way in which they extract those natural resources. They could stimulate the industries related to manufacturing, e.g. the steel and the engineering industry, of course. So those industries will start to also do well. Finalizing the implementation of a globally accepted mining policy. will attract more investment, reducing labor actions through appropriate wage negotiations, motivating workers with production incentives as additional income. So this is how they can do it. Right, then we have this one here. We call it a typical business cycle. You'll see we are going to show you a real business cycle just now. Okay, so this one we call it a typical business cycle. It doesn't really happen this way in reality. So this one is smoothened out for explaining purposes. Identify, okay, yeah, so this is a recession, depression, recovery, prosperity. This is a trend line. This is a trough. This is a peak. This is a peak. Okay, the distance here is the amplitude. Okay, this here is the length. Yeah, that's about it. Right, then the question, identify the trend line. Okay, that will be K. Which letter represents a trough? That will be D. Briefly describe the term business cycle, successive periods of fluctuations in economic activity. Explain economic activity during phase EF. Let's look at EF, or during a prosperity. The question is, what is happening during a prosperity? The economy is growing and improving rapidly. And obviously you'd expect inflation to happen. More businesses open up and more workers are hired. Why? Because there's a great degree of optimism during this time. Increased demand for credit, which increases interest rates. Higher demand for higher prices for capital. Profits and salaries increase. Higher inflation. Right, how can the length, this L, BF, be used to focus? Okay, you know what we do normally. All right, this, okay, it's more like this is, okay, let me look for, all right, and try to just copy what we have. All right, so it will be more like, okay, right, today is the 7th of September. All right, so after September, it's months that we don't know. Like, we don't know what's going to happen in September, October, November, December, going, you see, November, December, January, like that, going forward. So we can use the length to predict the next cycle. Okay, so depending on how long this took, we could use that to predict the next one. All right, and here we have another length here. We can use this to try and predict the next one. Okay, so yeah, that's how it's done mostly. The assumption will be, yeah, it's gonna, take more or less the same. So because the length remains relatively constant, one can focus that the next cycle will be similar. You see, so if a business cycle, for example, has a length of 12 years, it can be predicted that 12 years is what it's going to take for the next one to be, so exactly like I've shown you here. All right, the next question is, all right, this is, here they are referring it to as a real business cycle. I don't know, I'm going to show you another version of a real business cycle. And it gets a bit confusing then as to what we see here. Identify a trough. Okay, I won't say much because we've been doing it in the previous one. Identify a trough. A trough is right at the bottom. So we have this one, we have this one, and we have this one. Simple as that. During which year was the first business cycle fully completed? Okay, a complete cycle is the length of a cycle. So it's either from peak to peak or trough to trough. So since we don't have we're starting here from a trough, so it was reached in 2007. There, that'll be 2007, because this is a complete cycle. The next complete cycle was between 2008 and 9. So in 2008, late 2008, probably September, I don't know. See, then briefly describe the term real business cycle. Okay, this is what I was referring to. It says here, a real business cycle occurs when the effects of irregular events, see, like what we're going through currently, like this pandemic, COVID-19, it's an irregular event, or seasonal or long-term growth trends are removed from the time series data. All right, there's another version of what a real business cycle is, and this one here is from my textbook, but this one here, it's from the Reserve Bank's quarterly bulletin in 2016. You can check that document. All right, it says here, the graph below shows South Africa's real business cycle. Okay, do you see the difference between the one we were looking at, which was straight, like that? Look, this is a real business cycle. In reality, do you notice that during an upswing, we have this? You see, during a downswing, we have, it's more like we have business cycles during business cycles or in business cycles. So when it's not a smooth rise, it's not a straight line. Look, it's fluctuating frequently. Okay, anyone would expect it to happen this way, not like this. So now it gets confusing as to which one then is a real business cycle. So real business cycles have periods of increasing and decreasing. You see, there's within the business cycle, like as it goes up, you would see some elements of going down and elements of going up, but then something will be stronger than the other. Like here, the down is there, but the upward movement is stronger than the downward movement. Right, so this means that there are cycles within cycles. These periodic fluctuations within cycles are not shown in a typical. The typical one is the previous question we did, the one that is smoothened, the one that had letters A, B, C, whatever. Okay, all right, so let's continue with our activity. How can the South African government use government spending as fiscal measure? Okay, look, to stimulate. So if we want to stimulate economic activity and you have G as a tool, you have to increase it. This one is obvious. Government can increase economic activity by increasing. So the question here is asking, do we increase or decrease government spending? And obviously we increase it. Then how could the South African Reserve Bank have prevented the business cycle from plunging at T3? Right, you see here at T3, okay, you see that drop. How could the Reserve Bank, okay, so here we look at what tools the Reserve Bank have to their disposal. Okay, they could adjust the repo rate downwards. Okay, what could that do? It would make credit cheap. That means it would encourage people to buy on credit. And so when people are buying on credit, what's making them buy on credit? Number one is the fact that credit has become cheap. And besides the consumers, we also have businesses. When credit is cheap, businesses will go for credit and they start expanding. And for them to expand, they'll need factors of production. So it will force them to employ. So do you notice that economic activity will begin to recover? So the Reserve Bank could do that to avoid that plunge. Then the other thing they can do is decrease cash reserve requirements, like with the banks. And the next one will be buy securities in an open market. Okay, that means buy on the JSE, like buy companies. That's what this statement means. Stabilize the exchange rate. Yes, that means the rate between the rand and other currencies. Try to make it stable. And this also could mean them buying their own currency. And what it does is it creates demand for the rand. And if demand for the rand increases, you know what it means. It means that the rand is going to appreciate, and thereby making it stable. The next one is increase money supply, and money supply is increased by simply printing more banknotes and minting more coins. Right, the next question, let's see here. Study this cartoon and answer the questions that follow. What do I see here? Okay, trouble ahead. Okay, there's a clue. South African economy, you see, going down. And then we are very close to a recession. Okay, so we're going through a downward moving. Remember what we call an official an official recession. Okay, so we're going down first quarter, down second quarter, down third quarter. Officially it's a recession. Yeah, that's the concept here. All right, then we have exchange rates. Remember, this is an economic indicator. We have inflation, it's an economic indicator. We have GDP, it's an economic indicator. We have economic and social performance indicators. So these are economic indicators. Identify two economic indicators in the cartoon. So it's those three things there. Briefly describe the term recession. Yes, I've mentioned it. 3 consecutive, it's 2 actually. Now, for more than 2, so that means 3 and above. How will the initial stage in an economic downturn influence interest rates? At this point, I think interest rates will still be high because it will be after, this comes right after a prosperity. What can the South African Reserve Bank do to increase economic growth? Okay, this question is more or less the same as the one we did previously. So they should implement their monetary policy, but in an expansionary way. That means increasing what? Increasing money supply and reducing interest rates. All right, so you can go through this. That's easy. All right, South African economy closing in on a recession. Again, recession. South African economy is at risk of falling into a recession. The World Bank said as it cut the national growth focus for the year 0.8%. Growth in Africa's third largest economy. Okay, how do we know it's the third largest economy? We compare a real GDP with other countries. Okay, but that doesn't mean we have the third largest standards of living. Standards of living, that's another thing. We then divide the real GDP with the population we get per capita. That tells us about standards of living. Right, following a slump in commodity prices. Okay, so commodity prices decreased. So we're talking the likes of gold, copper, anything, those minerals, we're talking sugar, we're talking all those things. Okay, weakening demand from China. Okay, so China is not buying from us. That's what they're saying here. And the worst drought, okay, in more than a century, like over the last 100 years, the worst drought. Okay, good reason for a recession. The rand has plunged 14%. That's not stable. Against the dollar, that's not stable. Remember, one of the macroeconomic objectives is exchange rate stability. So if it goes down by 14%, this currency is not stable at all. In the past 3 months, as sentiment worsened, credit rating companies downgraded the country's credit rating because of growth risks. South Africa is projected to remain largely below the average growth rate of 4.5% for sub-Saharan Africa in 2016 to 2017. Against this backdrop, poverty in South Africa is set to rise as incomes fall. Okay, this is bad. Now, give 2 factors in the extract that contribute to poor performance in the economy. It will be these ones here. Okay, so we have the slump in commodity prices, the weakening demand from China, the drought, and the plunging of the rand. Sorry. What is a country's, okay, yes, 2 consecutive quarters. What impact will a downgrading of South Africa's credit rating have on this economy? Downgrading implies a bigger risk for investors. Look, so people would, if they have invested, they'll probably de-invest, and if people are becoming skeptical. They become skeptical, let me put it that way. The fact that South Africa will have very high levels of debt, will have to pay higher interest rates, which will definitely impact on lower income groups who will not be able to afford goods and services. Then there will be less money available for spending. That will put more pressure on the budget. The taxpayer will, as well as social grants and infrastructure development. The poor credit rating might increase poverty. That will drive a lower standard of living, which might lead to a recession. In your opinion, what can government do to stabilize business cycles? Okay, government can take monetary measures or fiscal measures. All right, and in this case, it will be trying to be expansionary. And let's have a look here. We have tax, we have government spending, we have money supply, we have the repo rate or interest rates. If you want to be expansionary, you will have to reduce tax, you would have to increase government spending, increase money supply, reduce interest rates. So that's what you can say also. All right, let's look at the next one. The next one here, okay, let's see what's going on. We have 2008, 9. Okay, so each bar here represents a quarter. Okay, so this will be quarter 1. So that is January, February, March, April, May, June, July, August, September, October, November, December, like that. So here we see this is growth almost 3%, 4 point something, almost 2%, and this is a negative. So here a recession. We'll see 3. Remember, according to our definition, we were saying 2, and these are 3. And this is now recovery and whatever, the economy is doing well. And then here it's not going down. What's going down is the rate of growth, so it's slowing. So the only negatives we have is 1, 2, 3, 4 over the past years. All right, so let's go to the questions. Which institution publishes information? Okay, it's written here, Stats SA. So that is Statistics South Africa. During which quarter in 2014 did South Africa experience a positive change? Okay, that will be second quarter. And I would like to show you what we have currently. This is what we are currently experiencing. And as of now, we are here, negative 2%. And we had negative 1.4% and negative 0. So this is officially a recession. And do you notice something? This is Q1 for 2012. This is January, February, March. Do you notice that this problem of a downward movement had started way before COVID-19? So we can't really say we are going through a recession because of COVID. Obviously, you would expect Q2 to be worse than anything you see here, because this has been bad. So I predict it will be way more than negative 2%, way more. Q2. Okay, we're waiting for the figures. And so this is in a nutshell what we are currently experiencing. So officially we are going through a recession. Back to the questions. What are the implications of recent trends in the GDP between 2011 and 14? All right, that the implications are a drop in the growth rate means less production. You see this thing here. So there's a drop, as you can see, decrease in income of businesses, retrenchment, decrease in income for workers, low standards of living. Explain the importance of GDP as an economic indicator. Okay, why is GDP important? Actually, it tells us, it confirms whether the economy is growing or not, and it's important because it might tell us a lot about the way we live. Because if this thing grows, it leads to economic development, and that means an improvement in people's standards of living. So you have to say something along those lines, then you'll be fine. All right, so it says here, measures economic growth from one year to the next, determines the standards of living in a country, compares prosperity levels among countries, like that. Right, then we go to the next question. Study the cartoon below and answer the questions that follow. All right, we see a tortoise here, and it's probably talking about slow growth. The words even say it's time to speed up the recovery. How do you speed it up if you have this kind of an economy? This says the recovery is slowing down. Then how can they tell? Okay, right. What message is depicted in the cartoon above? I've said it. The economy is slowing down. Recession. Give a reason for the current state of the economy. Okay, this one here was back then. So, but if you were to be asked this question now, part of what you could say it has, a lot to do with, if let's say this comes in 2020, you might want to talk about COVID-19. Okay, aggregate demand decreased, bankruptcy in businesses, world slowdown in economic activity, inflation rates increase. If this question is asked November 2020, it will be COVID-19. What main economic indicator is used to determine the state of the economy? That would be real GDP. Nothing more. Right? How can the government speed up the recovery of the economy? Government has these two. Speed up the recovery. Okay. Does it say fiscal measures? Okay. I wonder why we don't have monetary measures here. All right. They can reduce taxes, e.g. income tax or company tax. That will give, that will put more money. It will increase disposable income. Then government spending, it's going to cause the multiplier. They can increase government spending, e.g. that, or even infrastructure development. This will increase expenditure. Actually, it will create employment mostly, because if government spends money on the building of roads or improvement of infrastructure, they would have to employ. Companies will be awarded tenders, and those companies will employ, and that is government spending. So I wonder why we don't have fiscal measures here. Right, then I think this is the last one. Economic indicators. Okay, we have leading, lagging, and coincident, and also composite indicators. Economic indicators are statistics used to measure some aspects of the economy which help forecast, and what to forecast is to predict. Just like the weather forecast, they'll tell you it's going to rain, it's going to be cloudy, and so on. They'll tell you even for a week ahead. So that means they are forecasting. So we also have as economists, we also have a couple of things that we use to predict the future. And there are so many things, like we can use the trend line, we can use length, we can use the amplitude. There are so many ways. So we have leading indicators, we have lagging, we have coincident, and we have the composite. Okay, you see it's being asked to be defined there. Let's have a look. Identify a leading economic indicator from the above. All right, I didn't read the whole thing, but I think, there we have it. All right, so we have job advertising space. This is a leading indicator. Just think about it. Before the economy recovers, let's say, for instance, you might see, okay, remember that question we did where we were talking about a recession and stuff. Let's say we're going through a recession, and let's say the governor of the Reserve Bank reduces interest rates, and that makes credit very, very cheap. That could cause businesses to go for credit and go for expansion, as in to expand their businesses, and that is going to cause a recovery. But now when they do that, they'll have to advertise for job spaces. Like if a company has to expand, then they'll need employees, because the current ones that they have, they're already working, and so they're expanding. They'll need to advertise. So you notice that those job advertising space can be an indicator that we are heading towards this. So whether it increases or decreases, all those are indicators. If people are not advertising jobs, it's an indicator that we're probably heading towards a recession, something like that. Right, define the term composite indicator. I've done it already. It is a summary of various indicators of the same type into one single index. So the three composite indicators are often used to calculate a single composite indicator. Or maybe if we remove the word composite here, the three indicators like leading, lagging, coincident. Yes, like that. Then what does the amplitude of the business cycle demonstrate? Okay, it measures the intensity of a business cycle. Is that from a peak to a trough, that vertical distance there? So it demonstrates the power of underlying forces. It demonstrates the extent of change. A large amplitude shows a strength or severity of underlying forces. This is something like, okay, the difference between this and this. You see, the amplitude is, and the amplitude here is, you see. So the large amplitude, like this one here, it shows the strength or how severe these underlying forces of up and down. You see what we mean there. So it measures how intense a business cycle is. Okay, the larger the amplitude, the more extreme the changes that might occur. It shows how deep and how high the recession goes. The amplitude demonstrates the distance of the peak and the trough, troughs measured from the trend line. Then it indicates the effect of economic activity. Explain the length of a business cycle as a feature. We have done it before. It is used to predict, yes, just like even the amplitude. So you can use it again to predict the next intensity. Simple. And then the length can be used to predict the next one. Is measured from peak to peak or trough to trough. It's the time used to move through a complete business cycle. So if the length is 10 years, it can be predicted that it will take 10 years for the economy to move through another cycle. So it is used as a predictor. All right, this brings us to the end of the topic business cycles. The questions here were not as many as the ones in secular flow. You'll be seeing the next topic very soon, which is public sector. And if you're watching this in future, obviously I'll have uploaded it already. All right, so thank you so much.